So welcome everyone to the second video of the internal control lecture. We had worked through learning objectives 1 through 4 in the prior video, kind of finishing off with the documentation of internal control and a review of the flowcharts. So now we're going to look at learning objective 5. So I had mentioned this kind of briefly before, but let's dive in a little deeper to how internal control actually relates to a financial statement audit, especially to steps 3 and 4 of the, or stages 3 and 4 of the audit process. You see I have these highlighted here below in this 6-step process, right? So we're going to be kind of focusing on how internal controls really can then, once we get the understanding, now how does it impact what it is we are focused on for the audit. So assessing the risk of material misstatement, that's the stage 3. This is where once we've obtained the understanding of the client and the internal control, now let's think about risks that are related to the client in terms of risk to the incidence of a material misstatement making it through the audit process. And so we talked about assertions before, right? Those high-level assertions: completeness, existence, accuracy, evaluation, presentation, disclosure, cutoff, rights and obligations. And so the key is we want to think about risk to each of those assertions. And remember, we had taken those assertions and then applied them for a significant account to come up with the audit objectives, right? So we'll have an audit objective of completeness related to accounts payable, for example. And so we need to relate the risks to that audit objective in assertion. And so we're looking for risks that are obviously material, and asking the question is, once you identify the risk, do we think that it could result in a material misstatement? And then what's the likelihood, right? And just from a risk perspective, what's the probability of something bad happening times the cost or the magnitude of that happening, and that really gets at how important this risk is, right? Because there may be some risks where there's a really, really high probability but a very low magnitude, right? Like employees taking too many pens and pencils, right? So it's probably not going to be something, even though there's a high chance that's happening, it's probably not of a magnitude that's very high, and so even when you multiply those together, it's not going to be anything that firms often will set up really strong internal controls around. Whereas other incidences, like a factory burning down, right, even though it might be a lower probability because it's such a high magnitude, it could very well be something that we need to address through a series of controls. Okay, and when I say we, in this point, I'm thinking about from the firm or the client perspective. And so how do we kind of continue to delve into this risk of material misstatement? We're thinking about the different, and we had talked about this before, when we're thinking about the nature of the transactions, this routine, non-routine estimation. And for the most part, the routine transactions are going to have the strongest controls because it's something that we're doing, that the firm, the client is doing so often that it makes a lot of sense to invest time in designing controls around that area, just because these transactions are happening very frequently. The non-routine ones, those are the ones where they're still important and we still are designing controls around them, or we want our client to, but it's possible though that those controls aren't as well practiced, right? And therefore there might be some weaknesses there. So we need to consider when we're thinking about the risks that could occur that could result in a material misstatement. Then we're going to think about these categories differently, right, in terms of evaluating the internal controls and what's the likelihood that we could have an error given the nature of the transactions. Same thing for estimation, not same thing, but estimation transactions are also going to be a separate category we're looking at, where that will increase kind of the risk from our perspective, just because it may be hard to detect bias in the estimation, or the converse is it may be easy to for the client to insert bias into those estimation transactions, and therefore we want to pay special attention, close attention, to the internal controls over those transactions. Okay, so kind of continuing this on, thinking about these risks, we'll do this at the financial statement level. So what kind of internal controls are present at the kind of high level creation of financial statements. So for example, we'll look at the process to prepare the financial statements. What kind of controls are around kind of that process to go from the general ledger, creating trial balances, doing adjusting entries, all that, to creation of the financial statements and the notes. Especially, also thinking about how accounting policies are chosen, LIFO versus FIFO, straight line versus accelerated, what kind of controls are in place there for the selection of those controls. How are those controls then, for example, if there's a lot of IT, information technology in the accounting system, then how is a change in those methods, for example, actually implemented into the accounting system? We'll talk about IT controls on Thursday, or excuse me, in the next class. And so at the high level IT, there's different kinds of controls, but general controls are kind of general to the information technology and the accounting information system. And so we'd look at risks to those general controls, and then look in general about the control environment, tone at the top, all those things. And so if we look at kind of this financial statement level set of risks and think that they're on the high side, then the response of the auditors to then bring in better staff that are more capable of actually addressing those high risks, whether it's through more experience or some that are specialized, having more supervision, being more skeptical around the evidence that we're given, the explanations we're given from the client, incorporating more unpredictability in how we decide on testing. And so, for example, changing up the thresholds we might look at. So let's say, for example, for a given account, we might look for purchases over $1 million. Well, maybe this year we'll look at purchases that are over $750,000, right? Change up the threshold to see if anyone, for example, are the firms trying to sneak things in that are kind of just below our threshold. So we can be more unpredictable in that way. And then just increasing the nature, timing, and extent of the audit procedures, right? Those are all the responses from the audit team if there are high risks at that financial statement level. If we come down to the assertion level, and again, completeness, existence, cutoff, accuracy and valuation, rights and obligations, presentation, disclosure, if we're looking at risk at that level, then how do internal controls fit in? And so a couple of examples here. Let's say there's some impairment losses on long-lived assets. So if you remember that from your financial accounting courses, those would impact the valuation assertion, right? Impairment is, do we need to write down the asset? And that's all about valuation, right? So that's an example of a risk, is that there might be some unrecognized impairments, and so we'd want to look at internal controls around that. Same for inaccurate counting of inventory. If they don't have good controls on the inventory counting process at year end, that can impact valuation, right, through the ending balance of inventory, but also the ending balance impacts the flow out of inventory, which shows up in cost of goods sold, so it impacts the accuracy of that number, right? So we would look at, that would be a risk in terms of an inaccurate counting, inventory count. That's a risk that would impact valuation and accuracy for those respective accounts. And so, again, that's thinking about risk at the assertion level, and really at the audit objective level, because we're taking the assertion and pairing it with a significant account. And then what would be the response would be thinking about how we're going to balance testing controls and substantive testing around the risk, right? If there's good controls that are designed, then we'll look to test to see are they operating well. And then we might be able to reduce some of our substantive procedures, or we have to do more, right? So we'll kind of, as we see more, as we get deeper into this and kind of put applications on these, you'll see how this plays out. But this is kind of high level what we need to do in terms of dealing with risks now at the assertion level.